Hey, what's up, Market Moose? Mike for the Moose on the Loose. How are you doing on this Tuesday? So today we're going to talk about losing money because it sucks, right? But there's something worse than losing money when you invest is to lose that income because you budgeted for it and now it's gone. And then when you turn around, most of the time after a dividend cut, the asset that you invested in is not worth that much. So you have a 50% dividend cut, you have a 50% capital loss, pretty much go end in end, and then you're kind of stuck. You don't know if you have to sell and then try to just eat up that loss, but you also lose that forward income. So then we're gonna try to see some tricks to avoid that situation because it's painful. And of course, the tricks I'm gonna give you today are not going to put your portfolio 100% dividend cut proof. It's impossible. We get dividend cuts from time to time, and sometimes we got blinded by this, and then it's important to learn. I've suffered a few dividend cuts in my investment career. Since 2010, I've been a dividend growth investor, and I had like some dividend cutters in my portfolio, of course, but the point is to follow a clear path so you can avoid most of them. So first, before we talk about the 5 tricks I want to give you today, we have to understand like where the dividend cut comes from, right? So then you have to go back to the very basic of why does a company pay a dividend to its shareholders? And as a shareholder, you're just thinking about the income, about the dividend, and then you're super happy to get it. But let's switch side. You have a business, and then you have like cash in your bank account. Why in the world would you give that money for nothing in return, right? Because you're giving it back to the shareholder, but that's pretty much it. That's the end of the story. That's really an expense from the company's point of view. So why would they do that? Well, first, back to Finance 101. If you do not have any projects, having like money sitting in a bank account in a company, shareholders are not going to be happy. So they're going to request you to pay the dividend so they can reallocate the money elsewhere in a better way. So it is invested in projects so the shareholder can make more money elsewhere. So one way to attract investor and keep them with your business is to pay that dividend. And as you increase it, well, you pay a good yield, you increase it, investors are happy, they buy more shares, they stick to it. What happens to the stock price? Well, it's a good way to support it. So that's why there is dividend payments and dividend increases. So going back to why the company will have to cut it, well, of course, they have to cut it when the money is short. And this is what we want to avoid because the manager, the management team, the CEO will always prefer A, to keep his job, B, to pay the banker, and then C, maybe consider the shareholders. But in the first things first, they want to keep their job. They're going to think about the business. So they're going to pay the bankers first, and then you're going to come third or fourth or whatever down the line. So of course, they will cut the dividend. So now, here are the 5 tricks I use to either diminish the likelihood of having a dividend cut in my portfolio or the impact of that dividend cut in the portfolio. And that's how I suffered some dividend cut, but I didn't care that much. So trick number 1, make sure your investment thesis is backed by numbers. Skip the this company is going anywhere. That's been around forever. I mean, that's just balloonies. Intel, Walgreens, BC, just to name the few recent ones, they have been there forever. They've been leaders in their market, and they slashed their dividend. And actually, Walgreens it was even worse. They went back. They're not public anymore. They don't pay a dividend anymore. Intel suspended its dividend, and then BC is kind of like the best one out of those 3 with a small cut of like 50-something% on their dividend. So do not stick to the story. Look at the numbers. And if you want a good trick to understand how numbers work, I have a very good new webinar about that in 2 days on Thursday, and you can watch the replay. So you can subscribe at moosemarkets.com/webinar. It's 100% free. If you subscribe, you're going to receive the link for the replay, so you don't even have to attend live. But for the live session, I do a Q&A at the end, 1 hour, ask me anything. It's going to be a lot of fun. All right, so back to trick number 2. So now you know that the story that you tell yourself is not that important and numbers are important. But which kind of numbers, right? There are like hundreds of financial metrics to track. So my favorite, you know that, the dividend triangle. The dividend triangle is like the three pillars, the three foundation, the three sides of that triangle that will keep the business safe and thriving. So growing revenue, growing earnings, and growing dividend. So if you see a slowdown in those metrics, well, it tells you that there's a problem. I mean, if a company sees their sales slowing down, at one point there is so much they can cut in their budget and their expenses and so on. So eventually the earnings is going to follow. And a business that is struggling, growing their revenue and their profit, well, guess what? They will also struggle to pay the dividend. So it's just a matter of like common sense. You track what's the most important for any kind of business: sales, profit, and the ability to share that profit with shareholders. Moving to number 3, avoid bad combos. So you have those like combinations of ratios or facts that are really bad. So for example, a weak dividend triangle, so struggling revenue and earnings per share growth with a high yield. So the market is already sending you a signal that there is a high yield. So investors are not that interested in buying this stock. And on top of that, you look at the metrics and the metrics suck. So it kind of tells you you're not heading towards the right direction. Another bad combination is a high yield with a high payout ratio. I mean, kind of makes sense, right? So the company is paying a very high dividend. And on top of that, you see that there's little room left for the payment of the dividend and investing in a business. Because if a business is giving you all their profit, so 100% payout ratio, how it will be able to invest in the future and grow the business eventually. So you want to have a payout ratio that makes sense. You have to study the payout ratio metrics, of course. And there's a combination of high yield, high payout ratio. Well, it starts to smell bad. The third combo I can think of is a high payout ratio with no dividend growth. I mean, already a high payout ratio is a red flag, and it's doubled down by no dividend increase for the past 12 to 18 months. Already the company's sending you a strong signal that it's not going well. And you know what? If you have that combo, chances are if you look at the dividend triangle, it's going to be a trio, because the dividend triangle is going to be weak as well. In nowhere you're going to find a thriving business with growing sales and growing revenue and earnings, and then a high payout ratio and no dividend growth. Kind of weird. You're going to find low payout ratio and no dividend growth. That tells you a company like Constellation Software or WS Global, they will do a different capital allocation strategy. They will prefer to invest in their business instead of increasing their dividends. So that's different. But it's a low yield, strong revenue growth, strong earnings growth, low payout ratio, and then no dividend growth. So you have one red flag. All the other flags are actually green, so you're good to go. So see, it's important to put everything into a context. Now, 2 tricks that I use to minimize the impact of a dividend cut in my portfolio. The first one, super simple, income diversification. My DSR Pro dashboard provides me this pie chart of where the dividend income is coming from. So I can quickly identify if I have like one ETF or one stock paying me like 20-25% of my entire annual dividend income, well, that's a problem. That's a big problem, because if this asset goes wrong, well, then my entire retirement budget is at risk. So it's super easy to track with the DSR Pro dashboard. You can pull out that chart on your own if you like Excel and you like spending time, but we do it automatically for all our members. And on top of that, you can combine your portfolio, so it's even better. So by having multiple assets paying you the dividends and the distribution, you minimize the risk of like having a very big impact on one dividend cut. The second thing is to avoid sector concentration because some specific sectors, and they will gather most of the high yield, will include companies that have 2 things in common. They're capital intensive and there is low to medium growth potential. And with medium growth potential and a lot of capital that must be reinvested in the business, like telcos or pipelines and stuff like that, industrial sometimes, you increase the chance if you have like 5 pipelines and then 5 telcos. Well, if there's anything that goes wrong with those, you're going to take it in the teeth, and that's not going to be fun. I mean, if you think about telcos right now, You have Quebecor, TELUS, you have Cogeco, they increase their dividend, but you have BC that cut it. You have Rogers that is not increasing it. And before that, Shaw did not increase it as well. So you don't necessarily want to concentrate all your money into one place. Instead, focus on the best of class. So it's okay to invest in the telcos and the pipelines or any other sectors, but don't take 5 of them. Just pick the best one of each, and the best one is determined by the financial metrics. So to wrap this up before I let you go, 3 tricks to avoid a dividend cut. The first one, make sure the investment thesis is backed by numbers. The numbers you want to follow is the dividend triangle. You want to avoid bad combos into the financial metrics. Now, if you want to minimize the impact of a dividend cut in your portfolio, because it's going to happen no matter what, income diversification, so you don't want to receive a big chunk of money from one asset. And the other thing is avoid concentration in specific sector. A well-diversified portfolio, equally weighted stocks is going to be a lot easier. I mean, I got the dividend cut from Algonquin and Sylogist in the same year, and you know what? My portfolio was still performing and my dividend growth on my portfolio was still positive on that year. So it was not the end of the world because I followed those rules. So again, do not forget to register to the free webinar, moosemarkets.com/webinar. We're going to talk again tomorrow. And until then, don't forget to stay invested.